Ever wondered why large cap funds often struggle to outperform the index? In today's video, we will dive into a game-changing strategy that could significantly improve your large cap fund's performance, outshining the market. Watch the full video where we discuss how to generate alpha with large cap fund portfolio. Consider tracking this factor index, the Nifty 100 large cap index by mid cap index, or large cap index by small cap index. The current ratio chart of the large caps to mid caps stand at 1.3, closely aligning with the yellow line, making a historical minimal valuation. This implies that the large caps are currently trading at historical lows compared to mid caps and small caps. Consequently, this presents a right opportunity to invest in large caps with a potential for better capital appreciation compared to mid caps or small caps. Conversely, envision a scenario where large cap ratio hits the maximum, represented by the black dotted line. In such instances, it might be prudent for investors to consider selling out large caps and rotating or buying into mid caps and small caps, whichever is positioned closer to the yellow minimum valuation line at that time. Rather than blindly investing in large cap funds and being not able to beat the index, it is better to time the investments into large caps. Investing in large cap funds at these times when valuations indicates a potential upside is one way to generate an alpha or extra returns. The second point is about quality. Let's imagine large cap investing as buying a smartphone, a high quality and feature rich iPhone. The high quality here is represented in our case by return on equity, ROE. Large caps have the highest ROE at 16%. Compare this to other normal phones with lesser features or lesser ROE. Despite being top notch, our high quality iPhone or large caps come with a reasonable price tag indicated by price to earnings or PE ratio of 21.9 as opposed to the high prices of the lesser phones. In simple terms, the quality ROE reflects how awesome the phone is, and the value price to earnings PE ratio tells us if it's a good deal. Large caps not only provide top tier quality but also comes at a relatively cheaper price compared to other phones at these times. As a corollary, at a future time if they become expensive, you may do a similar exercise to see how you can rotate some profits into cheaper assets. Third is the large to giant movement. Which large cap company can become a giant company, and why would this happen? The largest global company is 15 times bigger than India's largest company. If you look at the global top 100 companies, only 3 names of Indian companies still appear here. So as India is expected to move up in the world ranking from 5th largest economy to say 3rd, many of the Indian large cap companies will climb up the global ranking order and become giant caps. Now comes a very interesting fourth point. Many large cap funds hug the index, meaning if the Reliance weightage in the index is 8%, then the fund's weight in Reliance stock is also close to 8%, plus or minus a bit. The idea is to be close to the stock's weight in the index. Hence, almost say 60% of the fund's stocks are similar to that of the index. The balance 40% is what is called active share, and this determines if a fund's performance is going to be better than the index. So if you need to generate an alpha in the large cap space, the active share has to be larger and must be less index hugging. You cannot beat the index by copying the index. If you look further, the 100 stocks that comprise the large cap index has delivered about 15% annualized return. However, if you could identify the top 25 best performing stocks on an average, you would have got 40% return. So identify the top 25 performers in the index will give you an opportunity to generate a 25% alpha. This is what Motilal Oswal Large Cap Fund NFO is claiming that they will try to do. Quant Large Cap Fund also tries not to hug the benchmark with an aim to generate this alpha. But having an active share can also lead to interim underperformance. The fifth and the final aspect to highlight is the downside protection offered by large cap funds shared in this chart. During the market correction period, it becomes evident that large cap consistently experience milder corrections compared to their mid cap or small cap counterparts. The true value of funds equipped with a downside protection becomes clear only during challenging periods, like recognizing the break significance when faced with a dangerous situation. Until then, investors may inadvertently overlook the importance of safeguards, fixating solely on accelerating portfolio returns. If you rank mutual fund performance in 4 quartiles, large caps were in the top 2 quartiles for 9 out of 11 years. This highlights their reliability and consistent track record. Invest in mutual funds based on your unique risk profile, financial goals, and time horizon. Make your investment journey personalized and aligned with your financial goals. Please consider liking this video and sharing it with your friends.